Okay.
Assalamu alaikum and good afternoon, everyone. Thank you for joining us today as we continue our series on your, or rather my financial journey. We are grateful to have Ms. Paris Riha, who will talk with us about taxation and retirement. Ms. Paris Riha is an associate wealth advisor with Arch Global Advisors in New York City. A little bit about Ms. Paris. Paris Riha is providing support as an associate wealth advisor to the partners at Arch Global Advisors. Ms. Riha completed her bachelor's degree with honors from Duke University with a major in neuroscience and minor in chemistry. In addition, Paris has received a certificate from Harvard Business School Online, completing courses in financial accounting, economics for managers, and business analytics. Prior to joining Arch Global Advisors, Ms. Riha worked at AXA Equitable Advisors as a financial consultant. Ms. Riha is an investment advisor representative and holds the following licenses: General Securities, Representative Registration, Series 7, Uniformed Combined State Law, Examination Registration, Series 66, and a New York State Life, Accident, and Health Insurance license. Paris was born and raised in New York City and is bilingual in Spanish. She loves to travel the world and considers Argentina a second home after living there for 5 years. Paris is a fan of the Rangers, Cowboys, and River Plate, and also enjoys golf and tennis. She's also an active member in the community as a member of the Duke Alumni Admissions Advisory Committee. Thank you for joining us today, Paris. We are grateful for you to spend time with us and look forward to learning from you.
Hi, everyone. Good afternoon. Thank you for joining me as we begin the second of 3 seminars that's focused on your financial journey. Before we begin, I'm going to take a minute to thank the APNA Women's Alliance, the Alliance organization, and Nazia Hussein for having us sponsor this event. And also a big congratulations to the Alliance organization on becoming a registered 401c3 or 501c3, my apologies. It's great news. That's a big accomplishment. Today, during this seminar, we're going to be taking a deeper dive into taxation and retirement. It's really great to have the opportunity to be here with you and share some information on our firm, what we do, and most importantly, how we can help you. Just to give some background before we start out, Arch Global Advisors has been working with APNA and their subchapters for the last 14 years. We've also been working with physicians for over 15 years, and I'd say almost 60% of our clients work in the healthcare industry. That being said, we've had a lot of experience working with problems physicians face in financial planning and providing them with the right solutions. I know Nazia gave an excellent introduction to who I am and my background, but I'll tell you a little bit about myself as well. My name is Paris Riha. I'm an associate wealth advisor here at Arch Global Advisors. However, I do come from a different background. I'm not a physician, as many of you might be, but I did have a background in medicine. I studied neuroscience and chemistry with honors at Duke University and continued all the way up until about halfway through medical school. During my time in school and working in hospitals, I realized that there was a big gap that needed to be filled. And that was that women needed help in finance, especially women physicians. Now, not only did I see this gap, it was actually what I experienced myself. During school and during college, I never knew really where I stood financially, and I never knew where I stood in terms of retirement. This is one of the biggest reasons why I decided to change and pursue a career in finance, in hopes to help other women in medicine have a better understanding and take control of their financial situation. I, out of anyone, would know how much work goes into being a physician and how little time you have. It's my hope that I can take some pressure off by helping you financially. Who we are, Arch Global Advisors is an independent registered investment advisory firm. We're located in New York City, Midtown, although we have clients all throughout the United States. I believe it's our approach that actually makes us stand out. We pride ourselves on being very accessible, and we combine the intimacy of a small firm with the products and services offered at any other larger firm. We work as a team with top attorneys and CPAs to deliver seamlessly integrated financial services and give clients a true holistic approach to their goals. Last but not least, we have a disciplined investment process, meaning that we keep our emotions out of all the decisions that we make. At Arch Global Advisors, our mission is clear. We want to be the most trusted guardian of our clients' wealth through life's journey as we provide meaningful solutions that make a difference throughout generations. Our vision is to bring renowned awareness to sound financial planning practices and to empower the communities that we live in by creating shared value. Now that you know a little bit more about myself and our company in general, I want to get back to the reason that I'm here today. And that is to talk to you more about physicians and finance, your financial journey, taxation and retirement, and most importantly, how we, Arch Global Advisors, can help you. First, let's take a quick look at physicians and finance. In general, a majority of physicians understand the importance of financial planning. This was a great thing to see because, as we learned last month, financial planning is one of the most important things you can do to secure your financial future. More than 50% of physicians have a net worth of over $1 million, and on average, earn a monthly income of around $20,000 to $30,000. Now, in terms of retirement, physicians tend to take advantage of retirement plans that feature relatively large annual contribution limits in order to get caught up on retirement savings. This, again, was another great finding because, as you'll learn today, it's important to take advantage and sign up for retirement plans offered to you. Contribute to those accounts every year and invest the money that you have in those accounts so that your money is being put to work for you. However, I found this interesting because even though all of those statistics I read to you, interestingly enough, even though physicians take advantage of those plans, only 6% consider them ahead of schedule when it comes to retirement savings. So, what about the financial education of physicians? Well, in a survey of physicians, 45% or less than half say they feel somewhat or not very knowledgeable about their personal finances. Similarly, we saw that 54% of physicians under 40 years old, 53% of physicians ages 40 to 59, and 46% of physicians ages 60 to 69 are behind of where they should be with their savings. As a result, we found that 37% of physicians under 40 years old, 32% of physicians between 40 and 59 years old, and 27% of physicians between ages 60 and 69 wish they had spent more time learning about financial planning earlier in their career. So why is it important for physicians to get a financial education? First of all, physicians need asset protection as much or more than anybody else. Physicians are their own biggest asset, and they should look at all types of insurance to protect themselves and their family. Because let's face it, there's only really actually a few things that can wipe out a doctor and their family financially, and that is death, disability, and liability. And all of these are all actually very easy to insure against. Second, doctors carry many more expenses that people don't have to. For example, physicians are often saddled with debt that they maintain during their medical education, in addition to both malpractice and disability insurance. Third, physicians have a late start. Some students might not get out of residency or training until they're at least 40 or 50 years old, thus making them lose those first few years of compounding, which can actually really make a big impact. Even though I'm addressing these topics here in our third seminar of your financial journey, I'm going to be addressing in more detail topics such as asset protection, estate planning, and saving and compounding. So you ask yourself, what are the challenges that physicians have to overcome for needing help with finances and getting more of a financial education? Well, if you take a look at the first one here, it's pretty obvious, which is that most doctors spend so much time working, it's not surprising that many of them actually neglect their personal financial planning. The average doctor works about 52 hours per week. Personal financial planning is especially important as doctors start increasing their earning power. Why? Because this is now, a physician is getting out of their training or residency and earning a higher salary for the first time. Now, everybody would probably figure that if you're earning a higher salary, you'd want all of the benefits that all of your friends have had for the years before you got out of residency or training. But it's important that they know how much to save, how much to use to pay off loans or debts, and how much to spend so that they can continue into retirement with the amount that they've earned. Physicians should talk about their plans with their financial advisor to learn more about what kind of financial planning options are available to them and make sure that they stay on the right track. There's also a bit of culture within academic medicine where you don't really discuss or talk about financial topics. So because there is not a lot of internal discussion regarding finances, a lot of physicians don't even know where to begin, leading to a later start in saving and planning. Most new doctors are also new to investing. When it comes to investing, there are two common ways to consider, and that is either consulting an advisor or using some do-it-yourself online platform. Now, even though people see the ease of doing it online and doing it themselves, they do tend to run into trouble because, as we saw in the seminar last month, the average investor doesn't compete in terms of returns, even with the standard indexes. Last, when you first enter a practice, hiring a financial advisor is not really a top of mind, but it should be. Having your finances in order is important, and it helps you to navigate savings, retirement, estate planning more effectively and efficiently. After all, you've spent the last decade spending hundreds of thousands of dollars pursuing your passion. It's important to protect the assets that you're earning now so that you can save them for the future. Let me read you a quote. A study found that the biggest mistake doctors make is simply not paying sufficient enough attention to their finances. I don't want that to be a regret for you, and that's where Arch Global Advisors can help. Doctors are as busy as it gets. The sooner you build a financial advisory team to manage your money, the more time you'll save now and the better off you'll be down the road. Now that we've gone through some information regarding physicians and finance, let's turn to the main points for today's seminar, and that's retirement and taxes. I know that I mentioned these steps in the last seminar, but I thought it was important to kind of review and refresh your memory and go over them again today. So these are steps to implement strategy. One is make retirement a top priority. A lot of individuals actually underestimate the power of retirement accounts. Taking advantage of a retirement account, including any employer match programs, will help you invest early and have another bucket of income once you retire. Don't just save, invest. As I discussed in the previous seminar, it's important to understand that investing works in your favor. And the sooner you invest instead of leaving your assets in cash, the more return you can make. Number 3, team up with an advisor. Advisors are here to help you. It's understandable to not know everything, but I'd like to help you out financially so that you have at least one less thing to worry about. And number 4, have a financial plan. This is the most crucial step because creating a financial plan is important to understanding your finances, both currently and in the long run. So now in today's seminar, we're going to what we're going to do is take a deeper look into step number 1, and that's to make retirement a top priority. So, what exactly goes into retirement planning? There are a lot of different factors that go into retirement planning. So here's a general guideline of where to begin. Identifying your retirement goals, analyzing your current financial position, understanding your income sources, investment planning, planning for unforeseen life events, managing your retirement income, and continuously monitoring the retirement assets that you have. Now, Arch Global Advisors is here to help you through these steps by helping you create a financial plan and manage and monitor your retirement assets so that you don't have to. Overall, planning for retirement can seem pretty overwhelming. It is genuinely overwhelming for majority of the population. But in order to plan, it's important to take a look at this retirement equation and navigate through the different components with varying levels of control. So let me explain this to you. This is the retirement equation. And first, we want to acknowledge which factors are out of your control in terms of the retirement equation, which are market returns and the future of tax policy and legislative and regulatory reforms. Next, let's see which factors you have some control over, which are longevity and how long you work. Last, the factors you actually have total control over, which are maximizing your savings, understanding and managing spending, and being well diversified from an investment and tax perspective. Throughout this seminar, we're going to touch base on a majority of these factors. And with Arch Global Advisors by your side, we're going to help you look at this retirement equation and build a sound retirement plan. The best way to secure retirement is to develop a comprehensive retirement plan by focusing on the factors that you can control, but also evaluating the factors that are somewhat and completely out of your control. So why is retirement planning so important? To help you maintain the lifestyle that you're currently familiar with, to make sure that you're self-sufficient and you don't have to depend on others, to provide extra savings for emergencies, and because life expectancy is increasing, which we went over in last month's seminar, and because you can't continue to work forever, even if you want to. So let's take a more detailed look into that last point. Over the last 20 years, we've seen that more and more people are continuing to work at older ages. This is demonstrated here on the top graph, where you can see that the percentages of people in the workforce from ages 65 to 74 and age 75 or older. As you can see, there's going to be many more retirees or civilians in the workforce over the age of 65 in the next coming 10 years. This demographic shift will undoubtedly have implications in the retirement system as a whole. Interestingly enough, though, if we take a look at the chart here in the bottom, it shows why people work in retirement and actually highlights how retirement is changing. More people are actually working due to positive reasons, such as wanting to stay active in their life and because they enjoy work rather than financial reasons. This is one of the best things that I could have ever read, because how great is that to hear that more people are working later in life just purely motivated by the desire to do so. That being said, while a lot more people want to continue working because they desire to do so, not everybody actually can. So if we take a look at this chart over here, we see that a higher percentage of individuals currently working expect to actually work until age 65 or older. However, as it shows on the side, we can see here from actual experience of retirees that it's very different, with only 30% saying that they retired earlier than expected. So if you look over here, out of those who retired earlier than planned, The reason, unfortunately, was mostly due to health problems, disability, or due to changes at their company. The reason why this slide is actually one of the most important is because clients need to create a financial backup plan in the event that they're not able to work as long as they expected. Because let's face it, that's one of the things that you don't have control over when you retire, and that's when you finish working. Now, once you structure a financial backup plan, in case you have to retire early, how do you start structuring your portfolio? Lucky for you, Arch Global Advisors is here to help you out with that. So the bucket strategy is something that I started to address in our first seminar, but let's take another look here. It's important to have at least 3 different buckets to help investors maintain a disciplined investment strategy. So for the short-term bucket, as you can see over here in the graph, it's usually invested in cash, and it should cover, I would say, about 1 or more year of a household income in retirement, determined through your risk tolerance and a lot of other factors. Then, as you can see below it, a cushion amount should also be maintained just in case there's any unexpected expenses that you might incur. Next, we have the intermediate bucket, which should start to have more of a growth component with equities, alternatives, and bonds, and any current income that's generated from the investments or dividends and interest should be periodically moved into the short-term bucket. The longer-term portfolio is more of a long-term care reserve fund or positioned for legacy planning purposes. Therefore, it can pursue more of a long-term retirement goal and have more things such as equities, bonds, and alternatives. Now that we've looked at the basic of how to structure your retirement planning, let's take a look at what retirement plans are actually available to you. In terms of individual retirement accounts, we have the Roth IRA, the traditional IRA, the 401k, and 403b. In terms of small business retirement accounts, we have the SEP IRA, the Simple IRA, and defined benefit plans. Last, the big question that everybody asks is, how can you save more for retirement? Actually, one of the best ways to save more for retirement is to increase how much you contribute to your retirement account, which is one of the most effective ways. Here you can see an example so I can illustrate that point for you. This here is a chart. It shows 3 individuals starting with a salary of $50,000 and increasing with inflation. It also has 100% employer match capped at 5%. So if you take a look, we have Super Sam. They start out at 10% contribution and stay with that 10% contribution. Then we have a Stubborn Sarah, on the other hand, who starts and sticks with a 3% contribution. Last, we have Escalating Ethan, who starts at 3%, but increases 1% annually, capping at a 10% contribution. So as you can see here, Super Sam does extremely well, but Stubborn Sarah is left pretty far behind, because even though Escalating Ethan starts out with small contributions, because they gradually increase over time, they end up in a position that's not actually too far behind Super Sam. In my opinion, this is a really effective way to show the power and value of escalating your contributions each year and how it compares to static contributions, both high and low in value. After that slide, the most important thing to discuss is how much can you actually contribute to your retirement plans. The truth is there's a lot of retirement plans out there, and there's a lot of contribution limits, tax deductions, requirements, and restrictions. I've provided these 2 slides for your convenience, but feel free to reach out to us at Arch Global Advisors. We can walk you through everything that you need to know for your plan in particular, help you start a plan, or help you roll over a previous employer plan. So aside from retirement, one of the next biggest things for your financial journey is taxes. Now, I know that taxes are not very favorable in terms of a topic, but it's important that you have a general idea of how they work, how they affect you, and what changes might be made with the upcoming tax legislations. Of course, anytime you have questions regarding taxes, you should always consult a tax professional so that they can help guide you. So what should you know about taxes? We're definitely living in a changing tax environment. Investment decisions can have tax consequences that are not normally considered. And to better manage your taxes, it's important to consider tax diversification and the use of tax deferred vehicles. Now, similar to the slides that I provided for contribution limits for retirement plans, here's a general slide just to give you an idea of the tax rates for 2021. Again, it's important that you reach out to your tax professional for any tax advice. Now, the reason why I chose to do this seminar with taxation and retirement is because a lot of the time they actually go hand in hand. Taxes should be a part of every retirement planning discussion. Why? Because part of planning retirement should be planning for taxes. First of all, something to be aware of is that Social Security benefits can be partially taxed once an individual reaches $25,000 in combined income or $32,000 as a couple. You also want to make sure that you look at all of your different investment, saving, and retirement buckets to decide where you're going to take those assets from when you need them. This is because as a retiree, when you want to plan your withdrawals carefully to avoid inadvertently pushing yourself into a higher tax bracket. Last, some funds during retirement may be taxable when they're withdrawn, and some funds can be withdrawn tax-free. And of course, it's important to learn which ones are which. One method of managing tax liability in retirement is to help clients diversify their sources of income, which includes considering different buckets of income during retirement. So let's take a look here at which funds are taxable, tax deferred, tax-free when they're withdrawn during your retirement period. Tax deferred accounts, you have your traditional IRA, your 401k and 403bs, simple IRAs, SEP IRAs, and annuities. Then you have your taxable accounts, which are stocks and bonds, and your tax-free accounts, which are your Roth IRA and the cash value of your life insurance. So different tax advantage savings accounts have different tax characteristics. Investment growth in tax advantaged accounts is usually tax-free, as shown with the positive row here with investment growth. Now for retirement accounts, pre-tax and Roth, money may go in or come out tax-free, depending on the type of retirement account and if the deposits and withdrawals are qualified. Now, all of these accounts are designed for long-term savings, so generally there is penalties on early or non-qualified withdrawals. Of course, feel free to reach out to us at Arch Global Advisors. We can help you find and navigate tax implications for retirement strategies by your account types. Finally, regarding taxes, we're currently in a historically low tax rate environment. Therefore, there's a lot of risk due to political shift that tax increases may be proposed or passed. So here's what has been pieced together so far in terms of what President Joe Biden seems to stand for in terms of tax policy. Increasing income taxes and payroll taxes on certain taxpayers with high incomes, which is more than 400,000. Capping the tax benefit of itemized deductions at 28% of value for those earning more than $400,000. Eliminating step-up basis. Tax capital gains ordinary income rate for those earning more than 1 million. Raise corporate tax rate to 28% and implement at 15% corporate minimum tax. Reducing the estate gift GST exemption from the current 11.7 million to the 3.5 to 5 million range. Expand Social Security taxable wage base to include income above 400,000. So while we don't have a final policy proposal yet from the president, we do know that he has said about potential tax purposes, and many of them point to these higher income taxes, higher capital gains taxes, and higher estate gift and generation skipping transfer taxes. So to wrap things up here today, I wanted to circle back and tell you how we can help you with retirement and taxation, which is through our approach to wealth management. Our approach to wealth management consists of 5 steps to implement the right strategy for you. First, we engage by discussing your financial goals and needs. This is a huge part of our process because we genuinely want to get to know you. Then we explore and find out how much you owe, you spend, and we collect and decipher that information and data, and we design a plan with custom solutions. Now, just because we found a strategy for you doesn't mean that our process is over, because we have to actually implement that strategy by putting your financial plan to action. Most importantly, we manage and review your plan annually. In most firms, there's a lack of ongoing management, but here at Arch Global Advisors, we believe with each year, your income, your goals, and your needs change. And we're here to make sure that you're taken care of year after year. Once we've gone through these steps, we then discuss which investment vehicles will be appropriate. Our solutions range from investment planning to estate planning and retirement. For investment planning, we offer options in equity, fixed income, real estate, and commodities. As you might know, people are living longer. It's no surprise now to have someone live until 90 years old or more, and that's where we step in to create a long-term care retirement plan for you, to prepare you and make sure you have income for as long as you need. We help you to save money on taxes. And most importantly, through the asset protection and estate planning, we help keep your assets safe and leave more money to your family, which is very important to each and every client, because after all, that's what we're working for day in and day out, and that's to secure the financial future of our families. So what can you do today to get started? Let's not leave anything for tomorrow. Let's not leave anything behind. Let's take action today. Do you currently have retirement plans set up? Have you set up a retirement plan for your company? Are you taking advantage of all the retirement plans available to you? Do you have any IRAs from previous employers that can be rolled over? And are you navigating taxes for your retirement with a tax professional? Start planning now. Start making strategic choices for taxes and saving for retirement. Make 2021 and the upcoming 2022 the year to secure your financial future with the help of Arch Global Advisors. So contact us. Again, I want to thank our partners, APNA Women's Alliance, the Alliance Organization, and Nazia Hussein for having us sponsor this event and for giving us this opportunity.
Thank you very much, Paris. Now we're going to come to our question and answer session. We've received several questions, but we will start with a few in the remaining time. The first question is, when you retire, is your tax rate going to be higher or lower than it was when you were working?
That is a great question. And this really actually depends on each individual or couple and their financial situation. For example, a lot of couples, as I'm sure everyone is thinking, wants to have fun during retirement. They want to travel, they want to pick up hobbies. So a lot of the time people wind up saving a lot for retirement. Therefore, the income that you actually set aside for yourself in retirement might not actually be that much lower than what you're earning right now in your job. You should always consider what tax bracket you're currently in and what tax bracket you might be in during retirement. Withdrawals from retirement accounts might also count towards income. So it's important to take a look at that as well and take that into consideration. As we talked about today in the seminar, the tax rate might also be higher in the future. So that's something that you should prepare for as well. So again, a lot of factors go into determining what tax bracket you might be in. And it's important always to consult a tax professional to make sure you get a better understanding of where you stand both now and in retirement.
Okay, thank you very much. Second question is, can you still contribute to an IRA after you retire?
Another great question. The answer is yes, but to contribute to an IRA, you must receive money from a job. If you're younger than age 50, the maximum amount you can contribute to an IRA for 2021 is $6,000. Anyone age 50 or older can contribute an extra 1,000 catch-up. So that brings the total amount to about 7,000 for 2021 for your IRA contribution. But yes, the answer is yes, but you have to be working in a job.
Okay, thank you. Are withdrawals from Roth IRAs tax-free once you retire, and are post-retirement rollovers from a 401k plan to a traditional IRA tax-free?
Another great question. Thank you for asking. And yes, Roth IRAs come with a big long-term tax advantage. So I know that we went over briefly the difference between Roth IRAs, traditional IRAs, and 401k plans. But you know, a 401k or traditional IRA, the accounts are funded with pre-tax dollars, which means even though they're tax advantaged by being tax deferred, you'll still wind up paying a tax on the money that you take out. A Roth IRA is different because that's actually funded with after-tax dollars. So your withdrawals when you're retiring are tax-free. Typically rollovers as well from a 401k plan to a traditional IRA are tax-free as well.
All right, thank you. Paris, our last question is, how can I start saving for retirement? Set up a retirement plan or roll over a previous employer plan?
Perfect question to end our seminar here on today. Arch Global Advisors is here to help you navigate through these questions. We can help you guide you where you want to go for retirement. We can help you set up a retirement plan, whether that be a Roth IRA, traditional IRA, 401k for your company. We can help you roll over previous 401ks or 403bs into a traditional IRA. Any questions or any information that you need on retirement, feel free to contact us. That's what we're here for. We're here to help you. And we're here to help you to make sure that you have a retirement that's well-funded.
Excellent. Thank you very much, Paris. Thank you for all the extremely important and informative information. I'm sure our members will benefit greatly from it, and I'm looking forward to continuing this series in our next webinar. Thank you very much.
Yes, thank you so much.
Goodbye.